let's look at the data. Over the last few weeks, the AI sector has just been a sea of red. And all the headlines, they're screaming bubble bursting, tech wreck. But is that what's really happening here? Or are we just looking at a glitch in the market's operating system?
Look, the market is a high-stakes poker game. It feels chaotic, it's definitely emotional, but it is not entirely random. If you can just filter out all that noise and focus on the hard data, sometimes you can spot the dealer's tell. It's that critical divergence that shows you what's really going on behind the curtain.
And believe me, right now, we are seeing a massive tell. On one side, you've got the mainstream story. The AI bubbles popped, the Fed is killing tech, it's a valuation reset we all knew was coming. But then you look at the data, and you see companies reporting record earnings. You see a $1 trillion global AI infrastructure rebuild that's just getting started. And the hyperscalers, I'm talking about the big dogs, Amazon, Microsoft, Google, they're spending over 400 times billion dollars a year. This isn't just some small disagreement, right? This is a fundamental break from reality that we have to investigate.
Okay, let's dive right in. Section 1, Decoding the Sell-Off. We're going to take that official story everyone's talking about, and we're going to put it aside for a minute. Instead, we're going to run a full system diagnostic and find the real root cause of all this volatility.
So, what is the official story? Oh, you've heard this a million times. Valuations are too high, the Fed might not cut rates, there was that government shutdown that created a so-called data fog, and of course you've got tariff worries and those coordinated short seller attacks. I mean, these are the usual suspects they roll out anytime the market gets a little nervous. Right? But here is the most crucial point. All of that stuff, it's just symptoms. They're the tremors you feel on the surface, but they are not the tectonic plates shifting underneath. To really, truly understand what's going on, we have to stop reacting to the headlines and start analyzing the market's internal plumbing. And that plumbing, it actually has a name: market microstructure. We're talking about the underlying framework of rules, the technologies, the high-frequency trading algos, and all the institutional practices that govern how trillions of dollars move every single day. And it's right here in the mechanics of the market itself that you can get these huge price dislocations that have absolutely nothing to do with how well a company is actually doing. So this brings us to the central question of this whole analysis. Are we just witnessing a healthy, totally normal market correction where prices are pulling back to more reasonable levels? Or is there something else going on, a forced structural liquidation event that's being driven by the system's own mechanics? To answer that question, we gotta follow the money. So let's move on to Section 2, Tracking Institutional Flows. We are looking for the trillion-dollar footprints left behind by the so-called smart money, because trust me, what they do tells a much deeper story than what they say. $400 billion. That's the annual spending on AI infrastructure from just 4 companies. While short-term traders are hitting the panic button, these giants are placing multi-decade bets with cold, hard cash. This is not a bet on next quarter's earnings report, okay? This is a bet on the entire next era of computing. Now, it's really easy to see institutions selling and just assume they've lost faith. But their behavior isn't that simple. What looks like panic selling on the surface is often just a series of logical structural moves. They're hedging massive gains they've made over the last year. They're deleveraging to manage their risk. They're repositioning capital to get ready for the next leg up. And maybe most importantly, they're using things like dark pools, these private exchanges where they can make enormous trades off the public market, to quietly accumulate huge positions during these dips without telling the rest of us what they're up to. Okay, this slide right here perfectly illustrates the dislocation we're talking about. The glitch is right here in the data. Just look at the price change on the left. SMCI, down 30%. Zscaler, down 20%. Palantir, down over 15%. Now, look at the revenue growth on the right. SMCI reports 65% growth. Zscaler, 26% growth. And Palantir had what many analysts call their best quarter ever. The price action you're seeing on your screen is completely, totally disconnected from the fundamental health of these businesses.
So let's pull all this data together. What does this all mean? That brings us to our final section, the data-driven outlook. We're going to weigh the probabilities here, looking at the bull case versus the bear case based on everything we've just uncovered.
So on the bull side, the evidence really suggests this is a temporary structural problem caused by the market's plumbing, not a fundamental breakdown. That massive institutional spending that confirms their long-term conviction, which could be creating a historic buying opportunity.
The bear case, though, and we have to be honest about this, acknowledges that the real macro headwinds from the Fed and inflation could get worse. Valuations are still stretched, even after this dip. And if negative sentiment really takes hold, the market can absolutely stay irrational longer than you can stay solvent. And this really brings us to the core thesis. The real glitch in the matrix is this. Information, narratives, fear, all of that now moves at the speed of light. But our financial plumbing, the actual microstructure that executes trillions in trades, it's still kind of running on dial-up. And that friction, that lag between digital sentiment and the physical settlement of trades, that is precisely what creates these predictable dislocations and the opportunities that come with that.
So what's the big takeaway here? You have to remain data dependent. You have to learn to tune out the noise from the headlines and instead watch the signal coming from those institutional flows, because the data, that's what tells the real story.
And remember, in a market this volatile, opportunity and risk are just two sides of the very same coin. Stay disciplined, stay liquid. And of course, the mandatory legal stuff. This analysis is purely for educational purposes. It's based on data that changes by the second. So please always do your own due diligence before making any investment decisions.
We are tracking these institutional flows in real time. So while you're analyzing your next move, check out the tools we use in the description below. You can sign up for Public and get $20 in free assets, check out Webull for that BTC promo, or look into NVDA over on Moomoo. All the links for that are right down below. And hey, if you got any value out of this deep dive analysis, do me a favor, hit that like button and subscribe for more.